Dr. Patti Peeples of the People's Collaborative, and welcome to the next episode of Patti's People, sponsored by the Evidence Base. I'm joined today by Natalie Douglas and Ragan Hart, investors and founders in the healthcare value space, for a rousing discussion on the investment arena for real-world evidence, HEOR, and the health technology arena. Natalie, Ragan, welcome.
Hi, Patti. Nice to be here.
I'd like to begin today by having each of you briefly describe your background and tell us a little bit about your experience in both founding and investing in companies. Natalie, let's start with you.
Thank you, Patti. Well, I'm a 30-year plus veteran in life sciences. I started my career within Big Pharma. As an entrepreneur, I then went on to build a global market-leading pharmaceutical services business where I brought in millions of dollars through private equity funding and raising debt through a major bank. I've been CEO twice of two private equity-backed businesses of varying sizes, so I've been exposed to working closely with private equity. Today, I'm founder of Lucidity LLC, which is in itself an investor in life sciences companies, and I also operate within that business model as a strategic advisor to private equity and venture capital. Bringing things up to date, I'm also an experienced non-executive director and currently chair two med tech companies, both of which are venture backed.
Thank you so much, Natalie. Ragan.
Hi, Ragan Hart. I am a serial entrepreneur turned operator turned investor, and now currently a strategic investor. And so started my career in development of clinical diagnostics and health technology assessment, and then moved over into venture creation on the financial investor side with regard to venture capital, and now sit on the strategic investor side, which means that I am today currently serve as a corporate venture capitalist, and so have a little bit different point of view than some of the other seats I've had at the table over the past several years in the emerging space of new technologies and healthcare.
Well, we're really, really honored to have both of you here. You have such a breadth of experience, and I'm hoping today that we can give our listeners some case studies and examples of what you've seen that's gone really right, what you've seen that you've learned from and your founders and investors have learned from as far as pitfalls. So I think we'll have both a rousing discussion as well as something with really excellent take-home points for the listeners. So let's get started. What is the big picture investment arena for real-world evidence, HEOR, and pricing access, data tech companies? Ragan, is it positive, negative, or neutral right now?
Yeah, Patti, great question. Is it positive, negative, or neutral? I'd say we have a positive outlook with regard to the emerging opportunities and pricing access, HEOR, data generation, RWE, and really the opportunity at the table here is how do any of those components and functionalities leverage emerging state-of-the-art technology capabilities to be able to bring together historical knowledge and expertise, but really focus on speed to insight in order to drive decisions for development, for speed to market. And so as a result, the outlook is positive. Recognizing if folks integrate technology capabilities to collectively bring together the knowledge that they already bring to bear.
So the technology component is really catching the eye in your estimation?
Yes, absolutely. I mean, it's technology first, recognizing that technology is only as good as how the user is using it. So technology with instructions, and I think right now, at least for the next couple of years, it's about not just using the technology, but but leveraging and technology in some of the cases that I'm referring to here is generative AI, that the moment of computation is being able to bring in, again, just troves and troves of data that we've historically had access to, but may not have been able to have it right at our fingertip, but then overlaid with human in the loop for the expert human to be able to trust and verify, but again, leading with the integration of technology into these core functionalities within HEOR, RWE, and data generation.
Natalie, I know you've worked closely with several firms with a unique and innovative technology component. What specifically caught your eye? Can you narrow it down a little bit without breaching any forms of confidentiality that really made you focus on that particular company and technology?
Yes, I think I've looked at several HEOR market access models more broadly, pricing and reimbursement models over the last few years. And I would certainly say that absolutely looking at those models over the last few years, those that are and have already adopted technology, those that are tech powered, obviously generative AI has become the in thing, and I think that is absolutely catching everybody's eye. But if I look at a few years ago, it was really, as Ragan said, looking at those sort of human intensive models, but how they were adopting technology to enhance their output, how they could develop greater, deeper insights on the data side than they, with their technology platforms, as opposed to just using human capital, and the speed at which that data was visible to the client. So I think that we've been in this place over the last few years. It's been an exciting place, and I would agree with Ragan that it's still a positive space to be, although I would say there's caution amongst the investor community at this point in time, because I think simply we were in a very frothy market a few years ago. I think investors were very excited about these new technologies, these new platforms, and perhaps a few years down the line now are starting to, first of all, become more savvy about what AI is, or what technology, what tech actually means, and what we mean by data value. So I think investors have been learning along the way. I think we saw some very high valuations as well, and we're clearly not in that marketplace at the moment. So we're getting back to sort of realistic business principles, even with these tech-enabled models.
Yeah, and if I may jump in quickly, great points, Natalie. That as the health economist in me appreciates that the market, from the investor point of view, is rationalizing a little bit more thoughtfully with regard to valuations, and how investors aren't just writing into paper napkins on the next best idea. Rather, so that's been helpful to see.
Mm-hmm. I was sitting on an investor call recently, and I heard the term thrown out that the investing arena was in a nuclear winter right now. Is that been your experience at all?
Well, I guess it depends on, it's in the eye of the beholder with regard to who's asking for the funds. I'd say that where we are currently is investors are in a position to be able to take a little bit longer than we'd seen in prior years with their diligence processes, right, wrong, or indifferent. But with that said, I mean, the funds that they've raised to go deploy and put the capital to work, it's time bound, and they're going to have to be finding new opportunities to get exposure to for working capital. So I think nuclear winter, it's somewhere in between. But in terms of, if you can show up with the proof points and clearly communicate your message, that you can try to find the right set of partners in the ecosystem.
We're going to dig further into how to present your company, and I think that's going to be really helpful. Let's say that you're a founder of a company in this space and you're considering exiting. What are some of the avenues available to founders as they deduce this decision? Natalie?
Well, I think, looking at funding avenues really depends on what size of business you are. And I think we can split it generally into those that are seeking venture capital and those that are seeking private equity. Very simply, if you're seeking private equity, you've got questions to ask yourself as to why you need private equity, particularly if you're generating EBITDA, which is actually what most private equity firms will be focused on. So it's really, making the choice about going the PE route or whether you can fund it via debt, for example, debt alone, perhaps a combination of both, but you're really probably weighing up debt and equity positions and looking at why you want to raise capital, what the benefit of doing that is, or what the need is for that, and then thinking about how you construct that. And that's going to depend on a number of factors. I think if you're looking, if you're in VC territory, certainly I can use examples from the businesses I work with at the moment. They've been funded largely through angels, high net worth syndicates, which are actually quite popular in the UK as an example market because it's tax efficient. Grants, lots of government grants, Innovate UK, that kind of grant situation can be hugely powerful to get these businesses moving and off the ground. And then, of course, you're going out to VCs, we're in that place at the moment. So certainly that's a very interesting, it's a very interesting place to be in a difficult landscape to some extent.
Mm-hmm. Does the US have similar grant options here?
So I'd say for what I'm most familiar with is a little bit down market within the private equity space over in venture capital, and the options on the table for businesses and startups is, I think there tends to be a misnomer with the appeal of venture capital without recognizing the set of terms it comes with. Mm-hmm. And that you really, to piggyback off of what Natalie was speaking to around what a good opportunity or great opportunity looks like to private equity on the EBITDA positive side, is within the earliest stage for venture capital, is that you really have to be honest with yourself and your business around what is the pace of growth. And then that's going to dictate some thoughtfulness around the type of capital that you want to take down. And because each of these different options comes with different terms that folks may not be familiar with in the sense of where you no longer have the control that you thought you did to build your business into what you need it to be or want it to be. In terms of, so in venture capital, it's a dilutive capital option. There are some non-dilutive capital options that exist. I think that folks tend to forget that they're there, but to the extent that you can bootstrap your business, even for some early proof points, that does put you in a position of higher leverage to then go out into the market and start entertaining conversations with investors for you to figure out who the right fit is to grow your business at the scale that you want to, and then also being responsive to the market opportunity.
Sorry, can I just add as well, just off the back of what Ragan has said, one of the other things we've seen emerge, particularly on the med tech side, is corporate venture arms. So this is something that can be really helpful for venture-backed businesses. I mean, to some extent, those seeking private equity as well, of course. But I'm just, if I look at the two med tech businesses that I work with at the moment, being able to tap into corporate venture arms or corporate venture funding is also a potential opportunity for certain types of technology where they can demonstrate significant value to a big pharma company, for example.
Explain a little more about corporate venture arms.
Well, a lot of big companies, big pharma, some of the bigger med device companies have developed their own venture funding arm. So it's like venture capital within the organization. And I think they've done that for very good and obvious reason, that they see that they need to look at investing early in some of these technologies and these innovations in order to give them the support and the opportunity that they need. For all the reasons we've already stated, venture capital is great, but it comes along with a lot of strings. And also sometimes what we see is a lot of, it's almost like bootstrapping with somebody else's money as well. These businesses sometimes need to grow more rapidly, and trying to secure additional funding can be really, really hard. So the corporate venture arms have been very acquisitive in the last few years and are very focused on tapping into talent coming out of universities in particular, and really looking at supporting some of these amazing technologies, because there's a lot of capability at that side or that end of the market these days, and they obviously want a piece of the action. And at some point that gives them an opportunity to acquire potentially at a very at a much more economical price, I would imagine.
That's a good point, Natalie. And from where I currently sit, as in the context of my lane as a corporate VC, I think another thing that folks interfacing with different types of investors need to recognize too, who is the context of the corporate, right? And that just because there may be, there absolutely totally agree with you, Natalie, this emergence of corporate venture functions that seem to have blossomed over the past couple of years, and also important to recognize kind of do your own diligence on know your corporate with regard to what are the strategic priorities of the corporate over the next 5 years, and how does your device or solution fit into that? Or if it doesn't fit into that, totally okay. There's a different set of corporate VC constituents that absolutely could be value add. And I think that's a nuance that tends to get lost, where once you've met one corporate venture capitalist, there's an assumption that we're all the same. And while we're frankly not, with regard to where the strategic priorities lie, despite being super excited about the innovation that you're bringing to bear.
So let's go back to square one for a founder that has never been down this road before. And their options that have been laid out are self-funding, VC, corporate venture, and PE. Have I left anything out?
And some non-dilutive grants.
Oh, right. So Ragan, why don't you take VC and describe how one might know that's an avenue. We're going to later come back to self-funding, so stick with VC.
Firstly, for a starter or for a founder starting at square one, what a phenomenal, brave, and significant adventure that you're taking upon, and we need more of you to change the world to the future state that we want to see. So, in terms of how you might contemplate the universe of VC opportunity, is you really have to think it's a numbers game in terms of how many people, how many VCs can you get in front of to be able to narrow it down to who is going to understand the opportunity that you're bringing to bear, but not just understand it. Then there's a one level deeper from a qualification perspective, is how does your opportunity map to the size of the fund and checks that they can write? And then further to that, how are you receiving value from their point of view? And so you start from, there are, in the age of information right now, there are innumerable lists out there that folks have organically put together in terms of spreadsheets, and with regard to, hey, there are all of these VCs, and I'm going to be US centric right here for a minute, around this list of as many US investors that we could find. And then it's cataloged or categorized by either they're generalist, meaning that they're investing all their sector and industry agnostic, and they happen to invest in the area that you might be focused on. So for instance, a generalist VC could be interested in making bets in healthcare, but that doesn't mean that they're a healthcare investor. And so there are some, again, the nuance around how do you understand, or trying to do as much homework as you can and recognizing too that you're trying to build your business and build your company, that coming back to where to start square one, there are a number of lists out there. Try to pare it down to which VCs are investing in the thesis that you're building your business in. And then the third angle is, what is a warm introduction that you can find, or even a lukewarm introduction that you can find to get the attention of the VC for that first pitch meeting.
Mm-hmm. Natalie, build off of Ragan's platform of VC and contrast PE to that, please.
Yeah, look, I think a lot of what Ragan has said about looking at VC funding applies when looking at private equity as well. But there's several additional points I would like to make. One is, particularly in healthcare, what's likely to be happening to you is that you're attracting private equity in the first instance. So I would say a lot of firms have been attracted by private equity because they've been sought by private equity, not necessarily because they're looking for private equity funding. And I think this is very relevant in the HEOR, the broader market access space, particularly with these sort of small to medium-sized enterprises. And so that turns heads as well, and it can be particularly not daunting, but it can be seen as a bit of a badge of honor for these founders whose heads may well get turned by the fact that they've got all of this attention. Because to be perfectly honest, where there's one private equity firm in this space, there'll be multiple others. And so really, if you've got a good business, they'll be hounding you, they'll be banging on your door. And it should give you the opportunity to step back and really think about whether private equity is right for you and what that actually means. I think I don't know whether it's an analogy, but if we think about the good, the bad, and the ugly, I think we can use each of those three categories when we think about working with or attracting or deciding to choose the private equity. But if we look at a brief description of the movie, The Good, the Bad, and the Ugly, I think this is even more relevant, where it states, The Good, the Bad, and the Ugly, the movie, is a bounty hunting expedition bringing two men together in an uncomfortable alliance. And I really liked that. I thought that was really neat, because of all the great things that private equity can help you with and can do for you, and we'll talk about those as well. You know, I work with private equity and I've worked closely with private equity. There's lots of good things, but I think going into it with no experience, you can be very naive to the implications. And a lot of what Ragan has said, it's just amplified with private equity. When you're bringing capital into your business from whomever, there's obligation and implication to that. And I think that if you're thinking about bringing private equity in, regardless of how the deal is structured, the financial side, you really have to think about choosing carefully. There has to be a good cultural fit. Your vision, and be clear about expectations, and this needs to be nailed down, I think, quite formally as you're entering this kind of arrangement, because your visions of the future may be entirely polar opposites, and they're not necessarily going to tell you that on the way in, because the personality from private equity you see when they're signing the deal with you is a very different personality to the one that shows up at the table at the point of an exit. So you're really, another movie, Jekyll and Hyde, maybe here. This is the stuff to bear in mind. And do your homework. A lot of what Ragan said, I fully agree with. Do your homework. Make sure that you reference potential private equity firms. Make sure you understand what they're like to work with, the good times, the bad times, and really think through how long that journey is going to be. How long are you going to be on this bounty hunting expedition? And how can you make it as comfortable an alliance as possible?
Does the amount of your current revenue or the expectation of the timing until the founder's exit, are those factors that send you down one road versus another, Ragan?
So it depends on the stage of the business. So really, within the venture capital asset class, the opportunity here is to be taking high risk, high reward. So they're actually in better times than what we're at right now, you're supposed to be taking bets on pre-revenue companies. Now, with that said, this is where, coming back to an earlier point that was made about investors having the ability to take to take a longer time in diligence, is that the goalposts have moved a little bit with regard to the type of proof points or traction that we would like to see relative to where we were writing checks and opportunities, again, not quite off of a napkin, but certainly off of some nice slideware and a great team. And there's nothing wrong with that. However, so long as you're understanding, again, of the implications and obligations of where and why we're placing our bet. But with that said, I mean, it does the revenue or path line of sight to revenue certainly does weigh into the influence of our decision. But that, again, coming back to how founders can do their diligence on the different types of investors, this is where you want to find out what stage of companies do they invest in. And you can ask them concretely, hey, on the revenue side, what are your expected revenue targets that would make me an attractive opportunity? And if folks aren't able to share that, then that speaks more to they're less disciplined with how they're actually investing their fund strategy. But typically, I'd say that would be the minority of investors, that we do have a target around what we would like to see. As a rule of thumb for revenue targets at certain stage, and then at the pre-seed stage, it's okay if you're pre-revenue, but again, that we want to try to build confidence and line of sight of how do you unlock that first dollar in based on the development that you're after.
Anything you want to add on the PE side, Natalie?
Yeah, just to add, fundamentally with PE, what they tend to do, depending on the size of the fund, the firm, they'll be very specific about the types of companies they will invest in, the size of the company. Typically they'll be looking at certain EBITDA levels or ranges before they're interested. They may be generalist or specialist, but they're going to reverse engineer it. Ultimately, they need to invest a certain amount of capital. They need to write a certain size of check, and they need to see the return for that. So they will have some, and they'll be looking at this from an algorithm perspective. And if you fit neatly into that, or potentially your model is going to fit neatly into that, then it's going to work. Lots of private equity firms can be interested in business models, but if they don't hit, let's say, a 5 million EBITDA, they're not going to be able to write a check. They can't invest. So it's kind of similar in VC world. Obviously everyone's got their limitations and their aspirations, but their specific requirements, because they're ultimately going to look at the rate of return. So yeah, there's an algorithm associated with it for sure from the investor side, and doing your research. As Ragan has already said, you've got to do your research on the firms that are in your sweet spot, or you've got to figure out how else you're going to get there with that investment structure.
You've both mentioned doing one's research. What are some of the resources, Ragan?
Other founders who have raised funds. And I think Natalie just made a point that I want to amplify over in the VC space, is to jump off of a comment I made earlier around sometimes there's a misnomer with regard to the appeal to venture capital, is that first and foremost, that what we're looking for is, are you building in a market that is at least $1 billion? And so what is that path to $100 million in ARR, annual recurring revenue, over a defined time period? And typically 5 to 7 years, different types of business models. There might be an expectation that augments that. But I think that's the starting basis to recognize what is the line of sight, again, that all models are useful, all models are wrong, some are useful with regard to the pro forma or financial models that you're putting in, or that you're building, or that you're having a team member help support. But coming back to the point of, as a rule of thumb, the asset class of how venture capital can be value add, that again, it's time bound, and that the market has to be big enough for the bet to be placed. And it's not to say, even if you're building a business, that the market opportunity is not $1 billion market opportunity, absolutely does not mean that it's not what the world needs. And but it just means that you need to think more thoughtfully around, is venture capital actually what I should be spending my time trying to raise, or should you evaluate some of the other options that we mentioned also exist in the ecosystem?
Can I just add to that as well, Patty? When I talk about EBITDA at around about a $5 million range or slightly above, that's almost a starting point for private equity. Really, private equity are doing far larger deals. You know, their entry level of interest might be at a $50 million EBITDA. Okay, but so their returns as well are going to need to be really significant. So I just wanted to make sure that there's appreciation for the fact that private equity comes in all shapes and sizes, but predominantly that's probably the very starting point where I explained the 5 million earlier.
Really helpful. What would define? Give me a case study, and Natalie, let's pick up with you here. Give me a case study of when you might advise a founder to stay with a self-funding option.
Oh, a self-funding option is a really it's a great place to be if you can do it. And there are a number of people that have done it really, really well. Have maybe gone from 0 to sort of 10 million revenues without, completely bootstrapping the business. And I think that, there are multiple models out there. Certainly when I went out looking for venture capital, we were a debt-free organization. There was, we developed a profitable business before needing to go out to private equity. And actually, I think that model, my example was I went to private equity. There were reasons to go to private equity. There were some existing shareholders that wanted to leave the business. The business was valuable at that point as well. And so there was a need to do it, to realize value for existing shareholders who wanted to go. And actually, there was a real opportunity to accelerate growth in the business. And I think there's a real tipping point as a founder, as a leader of a business, where you have to think about the future. And we'd rapidly grown, and the international expansion was really what I was after. The interesting thing is that the raise at the time was we did not over leverage the business. We put in a good, strong debt package, and we could have serviced that debt. We could have actually increased the debt and reduced the equity position. And this is the challenge for those this is maybe not the self-funding model that you're talking about, but really it uses perhaps several examples of when to think about bringing in additional or external capital, and whether that's equity or debt. I think that, and the decision was made, we did a combination of both, and that helped accelerate the business. We were able to pay off existing shareholders, and actually it was a very good growth story for the next 10 years. So it was a good decision. I think self-funding, if you've got a highly profitable cash generative business and you can see your way clear to continuing in that vein without putting your business under any pressure, or ensuring you can pay all your bills and manage your, enjoy your lifestyle, then there's no reason to bring in external capital. And actually these days, I think there's a need to encourage some founders to continue on that journey before going out for equity-based capital. So there's absolute nuance to it, but in general, you have more chance of self-funding if you're already highly profitable and cash generative. I don't know if Ragan would have additional comments to make, but that's general principles to me.
I would just add, if you have a cash flow positive and profitable business, to come see me. That's when I want to invest. The train's already left the station, and you're already executing on where the market is, where your market opportunity is. But that's typically less what I get to see, or what we're what we get to see again from that pre-revenue or early revenue stage of the business.
Exactly. The wheels are on the train. You don't want to go when the wheels are coming off the train, right? So Reagan, you've alluded a couple of times about making that first contact. What does a founder need to know about making that connection so that it sets up a future successful conversation?
Oh, what does the founder need to know to set up the successful conversation? I think a couple of things that come to mind that the founder should know is, uh, as an investor, we get to see the future every day with the pitches with how other founders are pitching us. And so with that said, your version of the future is going to be different than how we understand it. And that we need to that we need you to set the context in a simple, consumable manner, from a narrative point of view, versus immediately jumping into the nuance and differentiation of what you're building. And that's important as well, but really to take a step back and level set where we can appreciate the value that you're building or that you want to build. So that's when you get the meeting. How you get the meeting is, I mean, it truly is about who you know from a relationship perspective, and second degrees are also warm, second degrees of connection. And so to the point of, I know there are a lot of funds that say, or a lot of investors that say, hey, we'll take cold intros or we'll take cold pitches. Sure, that may be the case, but in terms of what gets the attention to set up that first meeting, to LinkedIn or some resources. Twitter, it has been an emerging resource. I think that that founders have really started to build community around exposing the good, the bad, and the ugly with regard to who to pitch to, who not to pitch to, and how to pitch to the ones that may be business or mission aligned to what you're out to build. I mean, the investing is truly a relationship business and relationship game, and that goes for both how investors are speaking to each other and how you want to establish the rapport up front. As it's a long-term commitment, or it could be a commitment again with unanticipated obligations and implications that you want to be digging into at that first touch point. What was your impression that you had, not just awaiting for the investor's first impression of you? And I think that can, again, that's going to start to divide who you would like to continue to spend more time with around. If given the opportunity to take their capital, is this the capital? And further, is this the right set of stakeholders around the table based on the check that they're willing to write?
But how much do you reveal in that first or very early contact stage?
I mean, it's how much you reveal is lead with authenticity and transparency around, again, but with a narrative for, hey, here's what we've been able to accomplish with the limited amount of time and limited amount of resources. Here's where we learned. And so now you're starting to demonstrate, or here's where we failed, but we quickly pivoted to X, Y, and Z. And so as an investor, I want to see that you have the resiliency to learn from the market, to learn from your early customers or your design partners, to learn from regulatory headwinds that may have popped up before you or after you started the business and we're out to build, to get to market. And so it truly is about how much to reveal is again going to be relative to if the investor group that you're speaking with has a portfolio company that operates in the same or similar space. This is another area that you can start to do some background research around with regard to not providing them competitive intelligence for free, but really checking in and even opening up a conversation. Hey, investor Ragan, I see that you're invested in this med tech company solving for this cardiology use case. We also are building a med tech company in the cardiology space. Before I share more, is that going to be competitive do you view that this, even without knowing many details, are you interested in investing in more than one med tech and cardiology? And so the founders should recognize that they should be able to feel empowered to frame let the investor qualify, versus having the investor dictate, hey, we want more information than what you're giving us. And so, and then that in that interaction, that's also allowing you to be able to qualify, is this going to be a good long-term partner or a good short-term partner or no partner at all? And I think unfortunately, the ecosystem tends to sway more toward the investors have more leverage and advantage. But as founders can get to talk to each other with other stages, companies similar to your stage of company, those are great resources as well, in addition to LinkedIn and Twitter.
Okay. Natalie, you've been on both sides of the coin as well. Tell me what you think about that, and what did you learn over the course of you pursuing your own funding as well as sitting in the catbird seat of choosing vehicles to invest in?
I think approaching the investor community is a strategy in itself for a business. And I think that there's multiple ways of doing it, particularly today. The starting point, though, for me, using my own experience, was actually creating a strong brand in my market, whether it was for my customers or whether it was the investor community. So actually, I built a brand, and it was a very strong brand that stood for something. So we attracted attention outside of the investor community as a result of that. Mm-hmm. And I think that's super helpful because the narrative is out there already. And that's a narrative that then you can talk to Ragan's point. If you're then going into sort of one-on-one, or you're trying to attract one-on-one sessions, hopefully there's some good news stories, or there's some intrigue, or there's something about you that the investors have already heard of. And it's one of the mantras that I try to explain to the VC-backed companies that I work with. It's all very well having a product that you've been spending years building. It's great getting approval for that. Of course, that's a huge journey. But along the way, you've kind of got to ready the market, whether it's your customer or whether it's your investor. So this is part of what I would call a strategy. It's part of the business strategy, for want of a better term. Mm-hmm. One of the other things we've seen emerge in certainly post-COVID as well is events. Lots of events where technology platforms and innovative businesses are meeting and combining directly with investors. And I think, some big events, like health, for example, and others. But we're seeing that on a smaller scale in country as well. There was a meeting, Health Tech X, just taking place in London this week. There was another one in Basel, Switzerland last week. So these seem to be on the increase. And this is a great place. I think visibility in general for emerging companies is vital. Sometimes there's a reluctance to spend money, going back to managing your cash very tightly. But there's things that I would put in the investment category, and attending conferences. A lot of these sort of events and conferences, you can get a free pass, a free ticket, and they will come from advisors or investment banks or other people in your network, because of course the most important thing for the organizer is to get an audience there. So you don't always have to pay. Being presenting at those events, it's a great opportunity to showcase your business model and get some feedback directly, and ideally get investors coming to you at the end of that presentation. So visibility, thinking and being more present externally is something I would encourage. And that isn't something that always comes naturally to non-commercial founders. It's scientists, engineers in general, not trying to offend anyone, but the sort of marketing, selling doesn't really come perhaps so naturally, and whereas to those of us that's absolutely core. So I think being externally visible, just touching on some of the points that Ragan made as well, my view would be try to avoid a cold approach, because the chances are you're going to get a cold shoulder. There's so many businesses looking for funding, and in a market like this as well, you've got to have credibility, and I think that credibility will come from a warm introduction. It could be if you've already got a VC funding, they will have a network, tap into that, tap into board members, tap into angel networks, tap into advisory firms. A lot of people will help you and want to connect you. With VC those seeking VC funding, maybe it's not possible to bring in an advisor or a broker to help bring those relationships to the table, but there are times when that approach actually really helps, because they're doing it's a really long job, it's a tough job, and it's a very specific job, and a lot of founders don't have those skills. So that can also be an approach, but really looking at networking and being visible externally is what I would say.
Mm-hmm.
And I would add that to Natalie's point around fundraising. You absolutely should go into it with a strategy, and even to time box. Hey, this is to the point I was making earlier around. Find these spreadsheets that have a list of investors that focus on the areas that you're wanting to build your business in, and that you really truly need to run a tight process to run a process period, and to time box it so that you get to be driving the process versus having to wait for the market to react to you. And that also that allows you to recognize, hey, if you've run the process for 60, 90 days, assuming that you're not able to get funded off of the napkin in the first 2 weeks, right? So we're coming back to some rationalization that then that's an opportunity for you to learn from the market around, hey, maybe this isn't the right set of capital I should be after. And how do you reflect that back to what the business needs?
So when a founder is putting their pitch together, what makes a great pitch, and what makes a pitch that needs to go back to the drawing board? Natalie?
Oh, why am I laughing? It's I mean, Ragan will have so much more value to add here, but in general, and she did touch on some of these points, but please avoid jargon. It's very easy to explain your business, but from your own perspective. And typically, your audience will not know anything about your model or your market, or sorry, not market, but they don't understand the inner workings of your model. So you've got to come at it from a different perspective. You have to think about the audience that you're talking to and what their level of understanding might be. So going back to Ragan's other points, do your research. What do they know about this space? What other models are similar? What do you think their understanding of, generative AI might be, as an example, or remote patient monitoring in the oncology space? I mean, these are the things that you need to try and understand, and you're going to need to pitch your deck to the audience that you're speaking to, bearing in mind you've done your research and hopefully you've got a short list of the best possible options. But I think avoiding jargon is the most obvious thing, and also not being the only person speaking. What the investors also want to look at, what all investors are looking at, is not just the product and the market potential, but how is there a team here? Is this a quality team? Is this a team that can actually deliver what they're talking about? A vision is one thing, a mirage is completely the opposite, right? And so they've got to have some faith in the people pitching the business. It's not just what you say, but it's who's saying it. And so I think clarity, avoiding jargon, telling a story and not making it too complicated, and sharing the pitch with your colleagues so that they can get a really good feel of what the business is about, what you're trying to do, and who's going to be capable of delivering it.
Add to that, would you, Ragan?
So the trained scientist in me is going to react to the comment I'm going to say next, and it is your pitch has to look good from a visual design perspective, and that is because we're seeing so many pitches. So how do you stand out? Is unfortunately, first impressions are everything, and you could have the best damn technology, best team, etc. But if it's not packaged in a way that, to Natalie's point, that reduces the jargon and doesn't simplify the message, and it does need to look good, that the visual designer or pitch designer is worth the expense, even in the earliest days. Now, in terms of the substance that we need to see is, what are the team is amazing, to Natalie's point, problem solution, and then how your model is tackling the problem set. But then further, can you call out a key set of risks that you believe that your business is going to be confronted by? And then that draws you the opportunity to be able to speak to how your team is going to overcome or mitigate those risks. And the reason I call that out is, on the investor point of view, we're trying to understand your business in the way that we're absolutely not the experts. You know the nuance, and we're trying to simplify it down to de-risk. And so if you can amplify the set of key risks, then it helps us appreciate that you're not just focused on the positive and the novelty of what you're after, but you're also accounting for the conditions around you that are outside of your control, which sometimes those conditions can be advantageous from a tailwinds perspective, and mostly they can be disadvantageous, but success is bred through how you're able to organize, you and the team that you've been able to bring to bear can organize mitigating the risks that you call out. And again, further amplifying the team piece, recognizing that the earliest stage, you may not be able to hire from a full-time or even a contracted perspective, a full-time expert. What you can do is augment the expertise that you need by bringing together a great set of advisors. And so again, it's a valuable indicator, an indicator that can demonstrate value to us on the investor side, that recognizes, hey, you're starting to form people around the table that have been here before and can help you see around the corner in a way that, again, you're focused on building the business, you're focused on leading the tech development, et cetera. And therefore you're not thinking necessarily around all of the risk. And, none of us can think of all of the risk, but in addition to team also means advisors. And so I think that's something that sometimes can get overlooked in the pitch deck. And folks may tend to expose that later on in the conversation, at which point it's a little too late at that point.
Understood.